Bloomberg Audio Studios. Podcasts, radio, news. You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
I want to get right to the economic data of the day. It is jobs day, and the change in non-farm payroll came in at 177,000. Consensus was 138, so it beat there. The prior period was revised down sharply from 228,000 to 185, so some cross currents there. Let's break it down with Tom Gimbel, Vice Chairman, American Staffing Association, and founder of LaSalle Networks. Hey, Tom, what do you take away from today's non-farm payroll data?
I think it shows that the U.S. economy is resilient. I think that the tariff hubbubaloo, for lack of a better word, hasn't hit yet. Companies didn't know what to do following the announcement the first week in April, so we have some time to show up on that. And I think the real message is small and medium-sized businesses always drive the jobs numbers more than anything else. And so if big companies do layoffs, small companies can now afford to hire some talent they couldn't before, and that's where you see a lot of the hiring.
So since you run one of the leading staffing and recruiting firms in the country, who's staffing and recruiting?
Well, I think that the companies that are hiring are small and medium-sized companies. You're not, when you see the announcements that a company like Starbucks is doing layoffs or what have you, is that you see that big companies have to cut overhead. But when you have small companies, the two sectors that I see a lot continue to be our healthcare, and you're going to have tech service firms. And service firms are going to continue to be doing consulting work. There's technology bases, things along those lines that aren't as directly affected by lack of inventory and trade tariffs of importing products from other countries.
Tom, some economists are concerned that tariffs and just economic uncertainty resulting from tariff discussions could hit small and mid-sized businesses harder because maybe they don't have the same profit margins and resources as some of the bigger companies. What are your, respondents in your surveys telling you?
Oh, I think there's no doubt about that I'm talking to leaders, CEOs of businesses every week. And there's obviously a concern due to the uncertainty of what's going on geopolitically and the tariffs. However, at the same time, is that labor, for the most part, can be scaled up and scaled down. And companies right now have to focus on where the opportunities lie. And so what we see right now is there is a fear, there is an uncertainty. However, there's also companies, small and medium-sized companies. Again, I want to repeat, if you're a small manufacturing company, you've got real challenges. If you're a small distribution company, you've got real challenges. But if you're a consulting firm, if you're a services business, if you're a technology app development company, there's still opportunity because companies have to figure out workarounds to the situation, and those are usually going to be technologically based solutions.
To the other side of it, those small, medium-sized businesses that are geared towards the consumer, selling stuff and products and manufacturing, et cetera, are they laying off people or are they just not hiring?
No, I think you're seeing both. Listen, companies are laying off. In good economies, companies lay people off. What you have is in a situation like this, companies have to look at their infrastructure. It's the same thing with unloading real estate during the COVID situation. They might not have needed it all along, but it gives them an excuse to do that. And so, for lack of a better phrase, are companies pruning some talent right now? They absolutely are. And at the same time, you see that if you go and look and search any job board, you're going to see that companies are also hiring weeks after they do layoffs because they're different skill sets, different positions. And so, the word hiring freeze is usually for new positions, but ones that are deemed to be necessary to the business, companies are always going to be hiring in those spots.
Labor hoarding, that's a term I learned during the pandemic. I'd never heard that before. Is that still a thing, Tom?
No, I don't think so. During the pandemic, when people were afraid that there was going to be a boom coming out, and there ended up being one at the end of 20 and all of 21 and some of 22, that made sense. But right now, companies are more sitting here saying, what puts us in the strongest position to compete no matter what the economic climate. And if you're a big company, you do have excess labor, and so it's easy to cut that back. If you're a small company, you couldn't always compete against big companies because you can't pay the same wage. Well, when those big companies prune and lay people off, now you can get some of that talent for a little bit lower price. And at the same time, those people are a little bit feel burned by the big companies. So you get a more engaged employee who really appreciates the quality of life at a smaller, medium-sized company.
All right. We appreciate it, Tom. Yep. Always good to get your perspective. Thank you so very much, Tom Gimbel, Vice Chairman, American Staffing Association, and founder of LaSalle Network, really helping to understand the difference of the big, large companies and the smaller, medium-sized businesses. I never thought that, like, if you get fired in a large firm, that the small, medium-sized firm benefits. That actually makes sense.
Good. Yeah, I guess in certain industries, certain areas. So we'll have to see.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Alix Steele here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news in business, economics, and finance through our lens of our Bloomberg Intelligence folks. They cover 2,000 companies and 130 industries all around the world. We also have an amazing bench of reporters as well as bureau chiefs that we like to tap as well. We're going to go to one of them now, Brooke Sutherland. She is the Boston Bureau Chief, one of my favorite people, one of the smartest people that I've ever met. So the headline for Boston is that President Trump has announced that Harvard University would lose its tax-exempt status, and that threatens to revoke the school's financial benefits. Brooke, what's the vibe in Boston right now?
I think the vibe is not great. I think there's a lot of concern about not just what happens with Harvard, but what happens with some of the other funding cuts, specifically around the NIH. This is an economy that really thrives off of its higher education institutions, its top-tier hospitals, and its research facilities. And these organizations support a much broader ecosystem that is very linked to Massachusetts employment and the other overall health of the state economy. And so this is an issue that state politicians have really, rallied around Harvard for, in terms of just really pushing back on this and trying to protect those interests that are key to their economy. We've even seen, the Republican candidate for governor coming out and advocating for the funding that goes to some of these institutions and the important role that they play in the Massachusetts economy.
What's the feeling, Brooke, as to the legality of such a move? Does the president have the legal authority to do so?
It's still not clear at this point whether or not his comments this morning about revoking Harvard's tax-exempt status actually came in conjunction with a directive from the IRS or from him in particular. It's not clear exactly sort of what steps are being taken or where we might be in any kind of process. Now, typically, the IRS standards prevent the president from interfering with federal tax agency decisions. And so this is undoubtedly something that if, the administration were to proceed with revoking Harvard's tax-exempt status, that you would likely see the university challenge that. And it's a process that would take years to play out between appeals and, negotiations over what might happen here.
So the dum-dums like me are going to be like, what's the big deal? They have a big endowment. They charge a lot to tuition. Like, why do they need the status? And what's the actual argument?
So the endowment is helpful, but you can't really use it like an ATM or, a piggy bank. The funds that are in there are mostly earmarked for certain programs, scholarships, certain schools. And so they can't just use that money as they wish to plug whatever gaps that they might have. Harvard is certainly in a better position to weather this storm than a lot of institutions. It's one of the oldest in the country and also the richest. But I still think the financial toll of this can be really significant, and it can affect how the university doles out financial aid. If they're not tax exempt, they would also have to pay property taxes. They have a lot of real estate, not just in Cambridge, but also in Boston proper. And that bill alone would be extremely substantial.
And stripping Harvard's tax-exempt status would deal a significant financial blow to the university. This is in the Bloomberg reporting, which receives an estimated $465 million in tax benefits annually. And it's not just Harvard. Brooke, looking at your reporting here, some 1,700 private colleges operate as nonprofits. Given their contributions to society, they receive that benefit part of a section of the Internal Revenue Service tax code, which specifically mentions education as being a purpose that can receive the exemption. So I'm guessing pretty much every private college and university around the country, Brooke, is looking to this Harvard case.
I think they definitely are. I mean, I think there's a question of whether, the administration is particularly targeting Harvard because it is so well known and so prestigious in terms of trying to effectuate some of the change that it wants to see on college campuses. It's sort of making a model out of Harvard versus some of the other universities in the country. But certainly, I think they are watching this very carefully. And if they're not, directly connected to this particular fight or going to see their own tax-exempt status called into question, they're likely feeling the pressure of the funding cuts because NIH funding does not just go to the Harvards and the MITs of the world. It also goes to a number of other universities spread out all across the country that are doing, very important work to advance U.S. competitiveness and things that we've decided are national priorities. Things around national security, around medical advancements, semiconductor research. I mean, this all takes money, and historically, that's a role that the government has played in supporting that research and innovation.
Brooke, before we let you go, I also touted your expertise in the industrial industry. You've covered the industrial industry for a very long time. You have a weekly newsletter that sort of picks up on all the little details happening within that very important space. And in your piece today, you talked about toothpaste versus like basically factory orders. Can you give me the takeaway from that? 'Cause I thought it was quite interesting as how we're looking at the economy.
Sure. I mean, I think there was a lot of concern heading into this earnings season about what we might see from the manufacturing economy. The thinking being that was sort of the front lines of where tariffs would hit. And these companies are certainly, expecting an impact, but by and large, they're mostly doing okay. I mean, the demand in the first quarter was very strong. And so far, companies really aren't flagging any kind of material step back or, some sort of serious pause in projects. It's a very different story on the consumer side of the economy, though. I mean, you've seen airlines pull their guidance because of a pullback in travel demand and concerns about consumer confidence. You've seen companies like Colgate-Palmolive, which makes toothpaste, with sales dropped about 3% in the first quarter, in part because customers are trading down from premium toothpaste options to sort of middle tier options. And that trade down effect is manifesting, in a number of different places across the consumer economy. And I think, it's just interesting. There was an argument a few years ago about could you see sort of a decoupling of the manufacturing sector from the rest of the economy because there are sort of secular reasons driving construction of new factories, whether it's reshoring or some of the energy initiatives that we've had, all of the government stimulus around infrastructure and semiconductors. That didn't happen. And I think it would be extremely difficult for that to happen again in an environment if we do see tariffs really dampen consumer confidence and really cause that consumer to pull back on spending. It's hard to keep industrial equipment orders going along at a robust place when people, can't afford sort of basic needs.
All right, Brooke, we really appreciate it. Thank you so very much. Brooke Sutherland, Boston Bureau Chief and Industrials Expert right here at Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
For a recap, Chevron made a bid to buy Hess. Hess accepted. And then Exxon came in and said, no, we have right of first refusal to Hess's project in Guyana, which is a prolific oil region. And they've been in arbitration for quite a long time on that. We may get a final result later on in this year. Vince Piazza heads up all our oil and industry coverage for Bloomberg Intelligence and joins me now. Vincent, what do you think of the answer that, nope, they got complete confidence? If Chevron doesn't get Hess, what happens?
Well, look, if Chevron doesn't get Hess, then someone of size would need to make a move on Hess, right? Exxon suggests that it has these preemptive rights. And so if the arbitration goes in its favor, there will be a decision that needs to be made about that value and what that value is. And I would suggest to you that because of Hess's size, the number of suitors for Hess, whether it's the asset or the entire entity, is quite limited. And you need someone that has the heft, the balance sheet, the flexibility, the financial flexibility an Exxon Mobil. And so I think both entities have a solid case to be made. I've never heard of an acquisition being held up because of a shared asset. But a lot of strange things have happened in the world in the last year or so. So we'll see what happens. But
right.
I think if you take a look at just the earnings from today, guys, I think it's obvious that Exxon is pulling away, both operationally and financially. And I think that if you were to take a look at this a year from now, you would see the ongoing strength of the Exxon operations and Exxon's financial health.
Right. So, hey, Vince, you've been covering these big oil companies, integrated oil companies, for years here. What are they telling you about life at below $60 a barrel, around $60 a barrel for WTI crude?
Life is sustainable when you have solid balance sheet and you have the financial strength. And in this case, you have Exxon Mobil, which paid back roughly $5 billion of debt. Balance sheet leverage is very, very manageable. They have the financial flexibility to push forward. Financially, they threw off about $9 billion of free cash flow, 8.8 to be exact. The cadence of buybacks remains the same. The dividend pace remains the same. So there is strength there in their confidence, in their decision to maintain those levels. Contrast that with what you heard from Chevron. And when you're throwing off roughly $1 billion of free cash flow and you're trying to pay out dividends of 3 and do buybacks of another 4, the math doesn't compute, right? And so that pretends the decision to scale back the buybacks closer to 2.5 or $3 billion for 2025. Hey, look, operationally, Exxon's in a strong position, especially in Guyana, especially in the Permian. You have Yellowtail likely coming on sooner than expected, most likely in 3Q. That's 250,000 barrels a day of gross capacity on a resource that has potential of well in excess of $6 billion. So you could understand the attraction for both Exxon and for Chevron. And, Exxon's in the driver's seat there. You have also for Exxon the Pioneer acquisition, the Permian Basin, which remains a strong, low-cost avenue for growth. So I'm not really concerned here if this dips below the $60 barrel range, especially when you have the balance sheet strength to push through that. Now, 15, 20 years ago, the economics were different, right? Leverage was a bigger source and also a bigger source of pain for these organizations as well. But for the most part, a lot of these names have gotten their balance sheets in the right size and the right shape. Maturities are quite manageable in 25 and 26. So I don't see the pain coming from any type of balance sheet event. And for the most part, what we're telling the operators is, let's manage that production. We want to see the free cash flow being thrown off. We don't want this excessive accelerated growth that we saw during Shale 1.0. We're in a different situation here. It's a mature industry. What we do want to see is much more capital discipline. And it's fine if you want to go out there and pay for an asset using your currency, using your equity, because your equity is valued higher than what a private equity sponsored company may be. And you can consolidate, integrate, and actually increase free cash flow going forward as well.
All right, Vince, thanks a lot. We really appreciate it. Vincent Piazza, he covers all the oil companies, E&Ps, as well as the big guys for Bloomberg Intelligence. We appreciate all of that insight. Shameless plug. You can check out my full Chevron interview on the Bloomberg podcast page on YouTube. It's also available on Bloomberg.com, and you can also check it out on the terminal as well. Shameless plug. I did it.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.